Welcome. This is the Trading Pit, your home for sophisticated takes on the crypto markets. It's July 2nd, and here in the XC studio is JJ and Ben Lilly of J Labs. I'm your host, Marconi White. Today I'm asking, are we nearing an end to this unbelievable chop? But first, it's rapid fire, where I look for simple answers to complex questions. Ben Lilly, we're going to kick it off with you. MicroStrategy market cap is 12x since it put Bitcoin on the balance sheet. Will the first company that adopts ETH on its balance sheet have a similar result?
Absolutely, and they'll have probably lower operating costs if they start to do business on Ethereum.
Oh, so they get a twofer. They're going to get double the benefits, double the pleasure.
Nailing it.
Wait, who do you think is going to do it? Is it going to be an old school like a railroad company that comes out going on ETH, or is it going to be a nice new tech company?
I think it'll be a tech company. I think it'll be something within the chip industry or AI.
Okay. JJ, the last time. Say that again?
Fuel to the fire for whatever narrative they're running with.
I love it. JJ, the last time Coinbase Premium was this low was October 23rd, right before the massive rally that sent Bitcoin to its current all-time high. Is this an optimistic sign?
Cautiously optimistic. Things could always get worse before they get better, right? So it's not a definitive bottom signal, but it's one of those things that if it starts turning around, that's a pretty good sign. So if you start to see that Coinbase Premium come back in, that's probably a good sign that the worst is over.
That's probably the best we're going to get from JJ. So that's pretty optimistic. Ben, Solana hits $1 billion in annualized revenue and fees and MEV. Can we call Solana a unicorn?
Absolutely. It's a heavyweight at this point. I think it's going to have staying power, and I think it'll really come on its own here in this cycle. Excited to see what it can do.
Man, you go back and listen to some of our early episodes talking about Solana. I think we've had a little bit of a sea change on this show. JJ, best way for a trader to survive summer ranging: beach, mountains, or chained to your chair?
The beach, man. The beach. It's the summer. Well, if you live near the beach, then go to the mountains. But if you live near the mountains, go to the beach. Change it up. Get outside. Don't watch this action unless you have to. Yeah.
Okay, you're not doing a padlock. Make sure that you're fixed to your chair.
No.
All right. I think that's good. Touch some grass, right?
Yep.
Then ETH ETF currently set to go live July 8th. What are your current expectations? Boom or bust?
You asked me like 3 weeks ago. I would say absolute boom, but the sentiment is just down in the dumps, it feels like, and equities are lagging except for just a couple of outliers. And it feels it feels difficult for Ethereum to go ahead and break out of this kind of sentiment slump, if you will. So I'm lukewarm here. I'm not boom or bust. I'm just thinking that it's going to happen and the market will start to show some strength, but overwhelmingly a boom. I'm a little hesitant on that.
Okay. A little bit on the fence. Well, I guess all we have to do is just wait and see. It's coming around the corner next week. JJ, last question we have here. Last week, the Supreme Court overturned the Chevron doctrine. Boom or bust for the industry?
Long-term boom. It's not going to be something that's immediate, but like the ETFs and whatnot, like all of the structure, you could see it being put in place. So when the macro conditions finally ease, we get cheap money again. Things are going to go insane, I'm sure. 2025.
Yeah, it's an interesting one. Just to riff on this one just a little bit. I think a lot of people that think that there's bureaucratic overreach in the United States are definitely cheering that this came out, 40 years of it going too far. Then you have other people pointing out that this could really hamstring some of these institutions, which have been going on their own rules and interpretations of laws for literally 40 years. A lot of unintended consequences. So it's interesting to see a little bit of an ideological divide.
Yep.
So
it's interesting. Things are changing. It's slow, right? It's so slow and gradual that it almost seems like it's not happening, but it is. It's just not at the rate we'd like it to.
It's been a ways coming too. Like this Chevron doctrine, everything that happened around it, it's been, I don't want to say telegraphed, but it's almost been expected for months now. And just seeing it actually progress. I mean, there was a lot of hesitation that it would get to this point. And the fact that it's here, it's pretty big. And we should not understate the significance here. It's almost like democracy is having kind of a rebirth, if you will.
Yeah, I couldn't agree more. It's exciting, honestly, for me, having seen this for a long time, having many lawyers in my family looking at this closely. But again, I think there's some interesting unintended consequences. I'm very curious to see what happens when we see some financial stress. The Fed or the Treasury, one of these other institutions, goes to change things, add liquidity, et cetera, and are sued in the court saying you don't actually have the power. Congress didn't give you that right. So yeah, very interesting.
Jerome is a lawyer, right? There's probably a reason.
Yeah, that's right. That's right. All right, well, let's move on to the actual markets. We're seeing some interesting activity. You know, I think just a week or so ago, we were expecting mid 50s. Now, as I pull up the charts today, Bitcoin has clearly come back from 60K. It was currently this morning sitting about 62. Ethereum right on the doorstep of the ETF is sitting about 3,400. And Sol, which seems to have the most variance right now, sitting about 149. Interestingly, when I looked at the ETFs, we had 5 days in a row of positive inflows. Not as much as what we saw at the beginning, sort of 9-digit, 10 digits. But just yesterday, I believe it was 130 million of fresh inflows. So JJ, break down what we're seeing from a Bitcoin perspective. You know, are you focused more on what's happening within the markets in terms of just where it's having some resistance or maybe some support from some of these 50-day, 100-day? Is it more the outside forces looking at the Dixie? What has kind of caught your eye, and where do you think is going to lead us to the next sort of stage in this range zone that we're in?
So this is kind of the best case scenario that we outlined last week. Like we said, the worst case would obviously be the bottom falls out. We see it go below the 200-day moving average. And at that point, you know, you're waiting 6 months or so for a recovery possibly to the upside. So it seems like Bitcoin's kind of stabilized a bit here. This is what we want to see, is some consolidation between 62 and 64. So long as this floor holds and we can kind of, it's not going to regain these trend lines overnight. Like maybe I think the best case scenario we're looking at now is a retest of the 50-day, which will probably fail and come back down to this 62 to 64 range. But most likely we're going to be in this range for at least a couple of weeks. Consolidate. What you want to see is these moving averages start to move lower and Bitcoin consolidate above them, right? And then that'll ultimately provide the momentum it needs to regain all of this lost trend throughout June as it kind of went through that bearish slump period. And we just have to see, because there's obviously so much supply overhang from things like Mt. Gox, US government selling, German government selling, and everybody who's been underwater from these buys that they made throughout June. So there's going to be a lot of resistance ahead. Not to say it's not going to make some short squeezes here and there. Obviously, there was a lot of people that kind of chased in at the lows on leverage, and you see that time and time again. The pendulum swings back. Things just got oversold, right? Like we were pointing out this RSI last week, that typically that's good for a bounce. We've had the bounce. Now we're just waiting to see how the market digests it. Is this as good as it gets? Does it return to the lows and ultimately retest that 200-day? Or can it form some momentum here and build a higher low? That's really going to be the story for the next couple of weeks here. And I think a lot of it depends on Dixie, which I'm sure we'll get into it a little bit.
Yeah, we'll definitely need to unpack the outside forces, and the Dixie's weighing hard. We were talking before the show about some of the jobs numbers and some of the narrative coming out that they're looking a little softer, maybe a little bit more of a push on the Fed, although I wouldn't count on that right now. Walk us through what you're seeing from an options perspective. We had a massive options expiry at the end of June. I think it was about, I want to say about over 6 billion. I looked at the options for the end of July. It's roughly half that, about 2.8 billion, a little bit below that. Did you see any fireworks that you were expecting to come out of that? Obviously, it wasn't enough of an impulse to push us, higher, closer to that 70K zone, but we are seeing a little bit of that support around 60K. And as I mentioned at the top of the show, we haven't really drifted below that into the 50K range.
Yeah, that was a bit of the worry, is that when those options expired, there's obviously a lot of 60K puts that were expiring at the end of Q2. When they expired, it created an opportunity for price to really fall below there without much support, but price bounced up. So that we got the relief rally, and IVs just continued to plummet. So that's the market telling you it just expects this range to continue further. We can see that pretty clearly here on the BVIV chart, which just seemingly has no bottom at the time. And I think realized volatility, again, just continues to fall lower and lower and lower. So it is that beach ball underwater effect is happening, whether that volatility is going to be realized to the upside or the downside in the coming weeks. I think that's going to depend on some of those outside forces we're always discussing. So it seems like it's coming. It's just not, there's nothing really actionable yet. We're just in this summer lull period. With options, you see a lot of people buying longer dated exposure, so out towards the end of December and they're selling shorter dated strikes for July, September, etc. So it just seems like the mood of the market is that quarter two is going to be much of the same. Basically, what we were alluding to is a bit more consolidation, regain some bullish momentum on the charts, and then maybe we get a nice setup for a surge towards the end of quarter three, quarter four.
JJ, just jumping in here, just 2 days ago, we saw the volatility index start to run as price was running. Do you make anything of that, or just kind of just a passing moment?
It seems like just a passing moment, right? It wasn't anything sustainable on here, and anytime you see it make those spikes, it just keeps falling to lower lows. So until you really see a firm spike back above 50, I think you should probably just be expecting more of the same from this.
Ben, yeah, I want to bring you up on here because you were looking at some data prior to the show that seemed to indicate we may starting to be seeing a little bit of that support, maybe a local bottom. Do you have some of that information? Were you ready to share that, or am I putting you on the spot?
Well, before the show, we were pulling up some of our internal metrics and charts, and there was one model that we pulled up and kind of had an interesting view there, which was Kari. Kari is one of our models that helps us predict volatility. And what that tends to do, it's not a directional type of volatility. Looks like we got it up here on the screen. It can precede movements to the downside, or it can precede them to the upside. And when we went ahead in the ETF and all the news surrounding it, and then the rally that we saw earlier this year, Kari was flashing for like two to 3 weeks. It was the most flashes we've seen over an extended period of time by Kari, and of course it resulted in an explosive move to the upside. Right now, it's starting to flash for the past, I guess, 4 or 5 days now. And it's not surprising because we've had a compression when it comes to price. I forget where I saw this, but it was like the 1 week Bollinger Band has compressed the most it has in a significant period of time, just suggesting that price volatility is just historically low. So forms of kind of low volatility are followed by moments of high volatility. So it's not really anything crazy, I would say, but the fact that it's starting to flash now is, your ears should perk up here.
This is BTC. What about Ethereum? Because we have the ETF, which is slated at this point to go live next week. We were joking before, is this going to be a boom and bust? Sentiment right now seems very muted. Don't seem to see a lot of interest. It's coming out in the middle of summer, which, as we've noted in the past, isn't necessarily a great period from an investment standpoint. Are you seeing anything from an ETH perspective that could give you some hope we're going to start to see some anything in the charts that may be different or signaling something different than what you're feeling from a sentiment point of view?
Not anything in particular. Kari for ETH is kind of showing the same signals that we're seeing here when it comes to Bitcoin. And, as far as Ethereum is concerned, a lot of people are trying to speculate on the potential inflows that the ETF could garner. And to that, I would say take some of that with a grain of salt. Because if we go back and we look at a lot of the Bitcoin flows, there really wasn't as much as was stated in terms of interest outside of crypto. It still seems pretty insular right now. And so a lot of the activity is probably going to be a little bit more crypto centric, at least early on. And of course, there'll probably be some bullish price movements associated with it. But is there anything that's looking overwhelmingly bullish on the charts? I don't see it. It's kind of got this line in the sand that it could go either way. And that's almost Kari is telling you too. It's volatility can expand in either direction right now. And
by those straddles.
Exactly. Yeah. We're all, I think this is one of those moments where the ETF is coming and it feels like a no-brainer. You don't really need to give it too much thought. Okay, the market's going to expand. It's going to allow more market participants and users and capital to be able to flow into Ethereum. So yeah, it must be a no-brainer that price is going to go up, right? And so we get into this bias, and we get into this everybody's in alignment in thinking. And that's when you kind of need to just caution yourselves. Like we don't always need to go with, overwhelmingly the bias of the market. Sometimes it doesn't work out that way. And then you get into this trap where you start overthinking things because it's like, you know what, really, it might just be that simple. So now you're forced into like, paralysis through analysis when it comes to the markets. But my paralysis through analysis right now, in terms of defining whether it's going to go up or down, if we just boil it down to that simple of a prediction, you look at the DXY just over the past few days. All price movements when it comes to crypto is, negatively correlated with DXY. Any sort of softness that the dollar has shown has resulted in strength on Bitcoin. And what worries me is if you actually overlay DXY with CL1, which is oil, you kind of get a little bit of a warning sign if you can look back over the past year and a half of that chart. And oil has been front running DXY. So we got it here on the chart, and you can kind of see that DXY there with the candle charts versus oil on the orange line. The orange line is making its move before DXY. And over the past few days, it's been trending up. It kind of had a bit of a breakout there. It's a little bit of a warning sign. I mean, if I were to only look at DXY on its own, that chart looks like it's ready to break down. But this suggests something else. So this is what I mean. This is what I mean. Right now, I think I have paralysis through analysis when it comes to up or down.
Even yesterday, like we had whatever it was, PMI came out below expectations. You saw Dixie sell off in the slightest, and then it's right back to the highs. So like the resilience of it, and that's one thing we've been saying over and over, is that like Dixie's going to tell you when it's ready to roll over. And it's just not there yet. You'll see it break down below at least 105.20, and right now it's just still encroaching on 106 again, So until you really see that firm breakdown there, it's just been a series of endless higher lows. That's been kind of the theme of the past month or so, is that it just wicks down and goes right back to the highs. So until we really see it roll over, there's no rush to try and get ahead of this thing, because the downside could be massive.
Yeah, the Sunday opening, it actually gapped down. It's kind of the biggest gap I've seen in quite a period of time, and it recovered pretty quickly. So what to make of that? I'm not entirely sure, to be quite frank. I mean, I know the dollar's supposed to be stronger because rates are going to be held higher for longer, and other central banks are starting to soften their stance when it comes to rates and policy. And in the US, it looks like for the July meeting is going to keep rates unchanged. So that would result in a stronger DXY. Of course, then, we'll get into it later, but the economy showing a little bit signs of softness, but not overwhelmingly.
Well,
soft.
Ben, why don't we get into it now? I mean, it sounds like there's nothing really to look at from an Ethereum perspective, because it's really the outside forces that are going to wag the dog. We talked this morning, I just mentioned earlier, we had some headline news that came out basically saying that jobs aren't looking as strong. We're not seeing as many people leave their jobs. We're not seeing as many job openings. Maybe a little bit more of that pressure building for the Fed to actually make some changes and potentially have at least the conversation on the table about a rate cut. And that then factoring into what the markets are looking at, rather than the absolute impact of a rate cut. So in your mind, as you're just going through the Dixie, what is that looking like in your, I mean, you oftentimes are looking at the dot plot, what people are actually expecting, but I mean, what else has kind of caught your eye? Are we looking at any changes in the near term?
I mean, the whole game right now is just looking at what is the expectation of what rates will be. Last week, we went ahead and we discussed the significance of when rates start to change quickly, what that sort of means in terms of where you're at in a rate cycle and relative to kind of overall indexes and stock prices and that sort of thing. So if you're kind of interested in more of a long-term view of what those rate cycles are, you can go back and look at last week's episode. But I bring that up now because we really want to stay honed in on what is that expectation. So right now, pull up the CME group and the expectation of what rates will be for September. So right now we're looking at July here, and then at the top, if we switch it to to September, we'll be able to see that the target rate, so the expectation right now that rates will have one cut has been trending higher. So 1 month ago, it was at 47%, then was 59% a week ago, and now it's 63%. So we're seeing greater consensus form around that September timeline for one cut. And the big question mark in the market at the moment is the Fed just waiting too long? Because they've had a lot of success of just doing nothing. And so the expectation is they might just wait to do something for too long. And how do they act when they realize that, you know what, maybe they did wait too long? Because inflation, like, what else can you really wait for? Like, how much more softness can you really expect before you get what you want? Like, there's really just not that much more juice to squeeze to get the numbers that you want right now. And then you look at, go ahead.
Yeah, I mean, when you say that, but I mean, a recession gives them the numbers they want, right?
It does, but what they really want is what's deleveraging. And so when you raise rates because you want the entire market to deleverage itself, you want to take some of the debt out of the room. You really want to take away toxic debt, unsustainable debt, and basically speculative debt is the way you can kind of look at that. And so you kind of do that through like capitulation of time. You keep rates elevated for an extended period of time to the point where you realize that businesses that are not that profitable just can't go ahead and pay their bills, so they go ahead, capitulate, BK, and close up shop. But the market has shown resilience. There's just been so much cash that flowed through the market, and you're seeing a lot of strength in the labor market, but they're just starting to see signs that there is a little bit of weakness, and the weakness is accelerating over the last couple months. And so the question then becomes, like, if that starts to accelerate, and you're sitting there waiting for another data point and another data point, are you going to be acting too late? Which means your 25 cut is not going to be of any significance. And so that's kind of, I think, what economists are generally looking for is that, look, some of these data points are showing some softness. People aren't moving. Construction markets are kind of getting depressed as well. Home building showing a little depression as well. Real estate agents are probably hurting pretty good here. Auto sales, interest rates at 8% right now on a 60-month mortgage is like, 8% versus what it was like 3-4 years ago at 4%. Like, that's going to have some impact that starts to cascade through the market. People start getting laid off. And it's at a certain point that starts to hit not escape velocity, but the rate of change of things starts to accelerate too quickly. And so economists are worried that, this is that time. Like, this is accelerating right now. And so if you're going to act, now is the time to act. Like, I have a feeling that, this July 31st, as we kind of go into the end of the year here, we're going to look back and think, maybe that was the meeting where it probably should have happened.
That was the surprising part about last month, the fact that they didn't go ahead and signal any dovishness, right? Like, we had cooler inflation prints, all the data points you're mentioning adding up, and they just kind of stuck to the script, which kind of tells you, I think, all you need to know from their perspective is it really does seem like they're angling towards that mass deleveraging event.
JJ, but from your perspective, I mean, you're really just, with everything that Ben just shared, that's not really factoring into your trades, right? You're really just focused, laser-eyed, hawk-eyed on the Dixie.
Yeah, so when you look at I think that's what the Dixie's telling you, right? Is that we keep having these data points that would traditionally move it lower, and it's not moving lower, right? So you have to ask yourself, why is that? What's changed in the market dynamics that when you get these cooler inflation prints, lower job numbers, et cetera, Dixie keeps going higher. So that's the market sending you a pretty strong warning signal. And if that continues, I think we have job reports in like 15 minutes. If we get another low jobs reading and you see Dixie higher, that's telling you the market dynamics have shifted, right? It's not the same environment that we had traded for the past year, 2 years, et cetera.
Yeah, it's a good point. Like, it's sitting, we mentioned there's like a line in the sand and we can go either way. It's going to be a volatility moment to the upside or the downside. So if we look at DXY, a lot of the things I'm mentioning suggest that, a cut should be happening. There should lead to a bit of a softer dollar, but we're not seeing it. Typically when price starts to hover around resistance and it takes too long for it to break through, like it's typically going to fail. But it is bouncing back. It's still forming higher lows on its current trend right now. So if it does kind of butt up against that as this kind of month continues on here towards that FOMC on the 31st, like that's probably a bit of a warning that it might just rip right through here in the next week or two.
Yeah.
So you have to be ready for it.
Well, and I don't think, I mean, we're not the geopolitical analysts that are going to be able to share the commentary there, but there's the news events that come out of Europe. Euro is 60% of the Dixie weighted index. And the news that comes out of there is not exactly something that investors are looking to rush into, right? You've got the elections that are just happening in France. You've got throughout most of Europe, you have these debates that are happening about what they should be doing to move forward. And so again, I'm not going the geopolitical, but I think from a pure investment perspective, if I'm looking for a safe haven, investors are continuing to come back to the dollar, which means just from a pure relative perspective, isn't it going to continue to strengthen?
Well, just jump in real quick and I'll give it to you, JJ. It's just that you mentioned, some of the news events happening in Europe. We don't need to try to predict the news events at the moment. It's just there will be something. If DXY decides to go ahead and break through the upside and rip, there will be a news event likely attached to it in some capacity. Whether it happens right before it or right after it, we're going to attach it to that moment. And there's a lot of things kind of floating around out there. I mean, you have multiple kind of geopolitical wars going on. We see oil price kind of moving, and we've seen a lot of dialogue and discussions as it relates to the Saudis. And then you also have an election. And so if, we saw the presentation that Biden gave last week, and I think everybody overwhelmingly believes right now that Biden will probably step to the side and there'll be a new candidate. Who is that new candidate? How does that factor into the strength of the dollar? Some of these things you should just go ahead and spend a little time and get some more paralysis, if you will, on your analysis. I think that's the word, or I guess the phrase of the day here. But go ahead and give it some thought, because once the event hits and you see the dollar, you want to be able to act accordingly. Because if it does rip to the upside, I mean, Bitcoin's been trending on the support for quite a long time, so that's going to be a pretty significant move if it does materialize.
Yeah, it's all correlations too. So like the market, it's run by algorithms and whatnot. And when there's a strong Dixie, it doesn't bode too well for risk. And that's just kind of the simplest way to look at it. You can attribute whatever factors to the stronger Dixie that you want, be it foreign geopolitics or just recession fears, mix of all of it. But the Dixie's going to tell you when something's wrong, right? So you see the Dixie start to break up above 106, Bitcoin break below 60K. That's probably as big of a warning post as you can get that you might be in for some turbulence there to the downside.
On the flip side of that, though, the expectation is that the Fed is not going to be able to sustain that long high Dixie if it's trying to see the cracks, not go too far to cause irreparable harm to the economy. Aren't they going to need to then do a mad rush in to the markets, do several cuts, almost the opposite of what we saw a year and a half ago, where rates just continue to climb at this extremely, accelerated.
Yeah, but think about trying to front run. Imagine trying to front run the COVID stimulus, the amount of downside you'd have to hold through, right? So it's a very, it's like a risky game of poker if you're trying to play against the Fed, like where they have access to that liquidity, but when they choose to unleash it, we don't know what, I'm sure they have some kind of model where it says, okay, if things get this bad, here's where we turn on the money printer and just inflate everything to death. But that might be, the S&P 500 down 50-60% from here. We have no idea what levels that's at, where their risk controls turn on, and who knows what Bitcoin's price looks like at that point, right? Like it could be conceivably down around 20K. And if you're buying here trying to front run a stimulus that could be 6 months out or longer, you could be in for a lot of pain.
And let's realize that those sitting in the ivory tower of the Federal Reserve, they probably want to see something buckle a bit. Like they want to see a bit of a deleverage. They want to see cracks form. They want to pull the tide out and see who's standing there, without their shorts on. It almost helps them better focus their policy efforts if they can see some of the pain in the marketplace. And they also, what's interesting here too is that they have the Jackson Symposium coming up. And so a lot of individuals, if they're leaving rates unchanged here in July, there's going to be a lot of focus and a lot of attention. He's probably going to say like literally nothing, just like he did last year. I think we were all like queuing into that press conference or that presentation, and it was just literally nothing. It's like he ran the presentation through a language model and try to make it come out as neutral as possible. And I have a feeling he probably does that now, and he'll probably do it here for this year. And this year's topic is reassessing the effectiveness and transmission of monetary policy. And right there, he's probably going to give a presentation where he's trying to, transmit to the public what monetary policy will be in the coming months, most likely, because September is kind of looking like that line in the sand of when he's going to make that cut. So a lot coming up. And DXY is hinting at it.
Yeah, and I think when I looked at the options coming back to crypto, when I looked at the options expiry for September, that's the next sort of large batch that we're going to experience. So it feels like, to your point, Ben, you're September, all eyes are on September, which kind of leaves us in this kind of demilitarized zone right now. Like, do you trade?
I do think we'll see the move manifest in July. I think like volatility's gone. So I think probably by, if not next week, then probably like the third week of July or so, sometime around then, you'll get pretty strong directional clues from the market because of how extended Dixie is now. Is that like it either has to form a proper parabolic breakout or retreat to below 105, 104. So I think we'll start to see those clues pretty shortly.
So you think it all happens before September?
That's typically the way it works, is when the options market's positioned for something in September, you'll see that happen a month or so prior.
Ben, what do you think? You just said it was going to happen in September.
Well, I think the rate cut is going to happen in September. And I think the market's going to start to know that ahead of time. It won't happen like at the FOMC at that month. It's going to be kind of known probably in the weeks in advance that, hey, you know what, we got 100% consensus, like this is happening. Markets will start running. And what was interesting is you saw a lot of like call buying in terms of the upside around September, which is kind of suggesting that a lot of traders are making that call that, look, September is the time period when we're going to see the market kind of come back to life. We're going to have the rate cut. There's going to be a lot of hot money that flows into riskier assets. And that's sort of the bigger bet being made right now. Just in my head, the question is like, are we going to see the downside first? And if so, will volatility spike? And if it does, will the positioning and weighting be any better than you have right now? And I don't have a clear-cut answer right there, but part of me is thinking to myself, like, what's the downside if you get in a little late? So yeah, price, maybe it doesn't make its move to the downside and DXY doesn't rip to the upside, and then you just see price start marching. You'll have a little bit of indication that the market is starting to strengthen, renewed interest, kind of movement to risk assets to get into that position. But if it does move to the downside and volatility does make it spike and we start progressing towards that September timeframe, is it going to be too late in terms of getting into position at a good pricing? Probably not. So like, where's the reward right now to go ahead and have to make that binary decision of up or down right now? In terms of like straddles, like, yeah, that's what you mentioned earlier, JJ. That seems to be the play right now. If 60% upside, probability and 40% downside, yeah, straddle it up.
If you were looking for that certainty, I think that's where we would come up, retest that 50-day moving average, and then drop back down to the 64, 62K range, consolidate a bit. And you'd see all these indicators start to turn bullish, and then we'd probably see that expansion to new all-time highs. At the same time, Dixie would be falling. Like, I think it's a very outlier scenario that we just, shoot up straight to 70K in a straight line from here. I don't think that's really, there's no signs of that in the market right now. Like, there's nothing signaling that that's even a slightest possibility at the moment.
And you did see volatility, or IV, like the pricing of volatility in the options market, rise alongside price. So if price did make its move, Two, what is that? Your 100-day moving average there, the green line?
50.
50-day moving average. Like volatility will start to expand. The call on your straddle will start to expand as well. And you'll be able, if in a savvy type of way, to be able to take that position and start positioning it better for the long term for the next move.
Yep. Yeah, there's always warning signs beforehand, right? And right now, like we were pointing out with that implied volatility chart, there's no signs that the market's found a bottom on that yet. And when it does, it's not, very rarely will just shoot directionally up in a straight line forever. Let's go back to that chart just to show you what I mean. Like it doesn't go from, it moves very rapidly, but it gives you a bit of a time period to prepare for it. So if you even look at here, there was a bit of a bottoming period back in February, and then it finally took off. So you had about a week or so to start to realize, okay, it looks like volatility's bottomed. It's starting to make some green candles to the upside. And even here, Bitcoin's still below 50K at this point, right? And then it really makes that large expansive move. So there'll be signs, and there's no need to try and call a bottom on implied volatility. Let the market just signal it for you.
So I want to kind of take us then to just talking specifically about positioning then. So we've got a Dixie that looks like it needs to make a decision in the next 2 weeks because it's overextended. We see early signs that the FOMC or that the Fed is likely going to start having at least conversations and maybe even have a rate cut in the September timeframe. The market's starting to position for that as we start to see the options expand for that. And we don't see any impulse right now that would lead to sort of a parabolic return to above the near-term all-time highs, right? For Bitcoin, and then I'm thinking for Ethereum as well, despite the fact we have the ETF coming out. So that's kind of the placemat of where we're looking. From you mentioned straddles, JJ. What do you think? I mean, there's a part of me that's saying, okay, based on all the information you just gave me, it makes more sense to be sitting in dry powder, waiting for the next 2 weeks to kind of expire to really see what that Dixie does. Because as you just said, it's not as if once it makes its move that you're going to not have at least some time to be getting in. As long as you're close enough to a terminal, you can make a move. I think other people are kind of itching to say, well, wait a second, why can't we just take the straddle right now, 60-40? How do you kind of think through that, those two options, and where would you land from a risk managed, proper risk managed perspective from your sort of your model, your system?
That's up to each individual, right? Like you have to weigh the risk.
Yeah, I'm asking for your system, JJ. I just asked you, not anybody else. You.
I think volatility is this low, Dixie's that high. I see the odds of a volatility event in July as pretty high, and the market's not really priced for that necessarily. So I think, again, you could look at this over, say you want to hold it through CPI next week and just see which way this ultimately breaks. You could look at something like the end of July, say 59K puts. This is just above.
Oh, hold on. Sorry, I just want to be really specific on what I'm asking for. So you're talking about next week. So you're thinking like you've got dry powder, and you're looking at it saying, okay, I'm gonna wait until I get a little bit more of conviction in which way the Dixie's going to go.
Yeah. So you could take like a starter position now, right? And then once you really feel you have a firm directional reading from the charts, be that today after the job numbers come out, how this weekly closes, et cetera, you could add to that. But I don't think it's a bad idea to start averaging into a straddle right now, just due to how low those implied volatility prices are, right? Like I think you want to at least nibble on some of that just due to the low contract pricing. I don't think it's going to stay this way for too much longer. I think we'll start to see, not to say it's going to go, straight back to 60 IV in a week, but I think we're going to start to see some bottoming signs here in the coming week or two.
Well, unless we have a breakout, right? Unless it goes the opposite direction, which we just talked about, unless I misunderstood.
No, I do think volatility is in the process of bottoming. Maybe it goes a little bit lower,
sorry.
but I mean, at these levels,
okay. You're talking about the volatility. I was thinking we were talking about Dixie. Okay.
Yep. And I think you just want to be exposed to both directions of volatility in the coming weeks.
So when exactly then are you looking for confluence between the Dixie breaks one way or the other, volatility breaks one way or the other? Is that when you start to really size into these positions with more of that dry powder?
I think that what you would see there is just a confluence on these charts. So you'd see Dixie either break above 106 and Bitcoin would fade back down to last week's lows. Dixie would keep chugging higher, and that's probably your best warning signal that we're about to experience volatility to the downside below the 200-day. Conversely, if we came back up, retested this 50-day moving average, volatility rises with it, Dixie sliding below say 104.50. And then as Bitcoin comes back down and retests that move up to the 50K line, probably bounce around 40 or 64 or so. Right there is where you'd be looking to add more longs, I believe. It's all path dependent, right? But that's kind of a rough outline of how I'd be looking at it. So we get that move to 66, comes back down, tested 62 to 64, see some consolidation to higher low, Dixie's moving lower. Those would be the signals that I'd be looking for to say, okay, it's time to add to the long side of that.
Well, I want to talk about sort of a 3 sigma type of event. We talked about if Dixie really roars hard, and we see, I mean, you mentioned, Bitcoin goes all the way back to 20K, right? So what are the warning signs that we're seeing the market completely getting washed out, that you really need to be in dry powder, or those hedges need to already be in place because the volatility is just going to whipsaw? What are you looking for there? Because I think that event should not be, although again, I said it's kind of 3 sigma, it's really an outlier. It could hit people pretty hard, especially when volatility has been as flat as it has been.
Mm-hmm. Yeah, you would see Dixie moving firm up above 106. Stocks would obviously be down well below their current prices, which are pretty overextended. You're starting to see a little bit of those warning signs now on ES and NQ, right? Like, look how overextended these are on the daily charts here. The weekly charts are overextended as well. And the biggest thing is these small caps. So these correlate pretty tightly with Bitcoin and Ethereum. So these are like basically the altcoins of legacy markets, the low profitability, high speculative companies, and they haven't been doing too well at all. So you would see these kind of fall off a ledge. They'd probably be trading below 195, 193. You start to see those breakdowns. Dixie's moving up. That's telling you, hey, liquidity's exiting the system. There's not really risk appetite. And I think a fast move to the downside for Bitcoin would be pretty quick to come. And you'd see it fall below that 200-day moving average, and that's really where we'd experience a lot of volatility.
So you're seeing the S&P have pull back from its overextension, Dixie roaring higher above 107, the Russell really starting to capitulate. All the signs are on the table at that point. You really need to be in risk off mode.
Mm-hmm. If nothing else, just sitting in dry powder, right, and waiting for the smoke to clear. Fine, don't try and knife catch it. It could get pretty slippery pretty quick.
Yeah, no, I think that's good perspective for those who are trying to remain bearish, particularly as we've talked about it many times in the show, right? What we're hoping to see in the end of this year, as well as going into 2025, is a continuation of this bull cycle. Nothing is taken for granted, right? It all is path dependent, right?
Yep.
Ben, you just mentioned that you're asking the question, when it's too late to be getting in? Do I have enough time? How are you thinking about the next couple of weeks, looking at trying to see if Dixie's going to capitulate, trying to see if the Fed is actually going to be talking about bringing rates down, even maybe doing at a point? How are you thinking about playing this market?
So it's going to feel like a 90-degree turn here, but I view it in time. So I do have, I mentioned before, paralysis through analysis. So how do I take myself out of that state and be able to make a decision in the market right now? And in doing so, there's a big time component that exists right now in terms of your capital. So where can you go ahead and essentially make the most in this time period with your capital? And this is where I kind of look at what's progressing on the Ethereum side of things, because that's a very sentiment is just terrible over there. There's a constant just bickering battle going on for all of these different topics. And I'm, frankly, like, half of me is just like, I don't care. I don't care about this debate that much anymore, guys. Like, there's a lot of opportunity out there. Can we please just focus on some of these things? The liquid restaking market right now is heating back up, and it's like nobody even realizes it. So Pendle right now, there's a lot of opportunities. A lot of people use it to go ahead and farm points. And on Pendle, they had a lot of expiries happen just recently. So there's been a lot of ETH tokens that have been leaving Pendle. So the TVL, if anybody's looking at those stats, have been dropping a lot. And that's the reason why. It has nothing to do with Pendle. If anything, Pendle is actually getting to be stronger of a platform. And when we think about time, having exposure to some of these new projects right now and allowing time to progress for the next month or two, like, you're in that position and you're essentially earning yield on projects that haven't even dropped a token yet. And one of them that I'm referring to is Symbiotic, which you can gain some exposure on Pendle through that liquid restaking platform, which is a competitor to Eigenlayer. And I have to imagine Symbiotic will try to attract as much of that kind of unlocked capital that exists in the market right now. And we would expect to see some incentives attached to it. You're probably going to see some attractive drops in terms of the points that they are offering come up. And I think they're going to even try to front run some other things in the marketplace. And that's kind of what a speculative side of things. There's also a project that you can see here called Mellow. And Mellow is an interesting protocol. It allows kind of entities to go ahead and manage how those tokens get restaked and kind of who they're restaking with, so they can take different types of risk, take on different types of risk with their positionings. And then you can basically just go ahead and allocate your ETH to these projects, and they'll go ahead and try to maximize returns based upon kind of your risk tolerance, if you will. And part of that is getting symbiotic drops. You can get mellow points. And so when we think of time and duration, just having capital sitting in an instrument like that, you know, you're earning points. Is it going to be a good return? You know, running some numbers back on EtherFi when it made its drop, if you had exposure, you know, you were in an awesome position. A lot of the protocols have given better returns than the current market, which is measured in terms of implied APY, have given out. And right now, those implied APYs are like 10 to 15%. I haven't seen it that low in months. So yes, attention and sentiment is terrible, which presents opportunity in the marketplace. And right there, you know, that is an opportunity that anybody that's sitting here wondering what to do, they should take a look at it. They should understand some of these protocols a little bit, understand the timing of things and how some of these projects are going to be positioning themselves to go ahead, earn users, earn capital, earn attention, and mind share on the Twitter sphere. So
Ben, I want to come at this angle because it's an interesting one to kind of put your capital to work for you, be able to get some returns. You know, if I think about the beginning part of this show, we're talking about the macro risks. So these outside forces that could really just prove to be a sledgehammer across all risk assets. And the fact that there's still this unknown, this ambiguity that we're experiencing over the next couple of weeks. If you're looking at putting your capital and locking it up for any significant period of time, are you sort of just discounting that risk and saying, listen, I'm in this for the long run. As long as I'm earning some Ethereum, I'm expecting it for the next 2, 3, 5, 10 years, I'm going to outperform because I'm really looking at stacking some ETH? Or are you really saying, no, in your mind, for your own risk calculation, you know what, I think I've got some time here. I can earn some yield. I'm putting this capital to work. I'm not having to move it between spot, stable, Ethereum. It's just a better performing play. And I think I won't have to worry about, you know, whatever the Dixie is going to do, whatever the Fed's going to do for another month, and then I can make a different decision.
Yeah, and great question. So I'll try to kind of summarize my view here. So Ethereum's trading at 34.40 right now. Let's just say it has an absolute, you know, DXY takes a sledgehammer to the markets like you mentioned, and Ethereum goes ahead, it breaks down on its prior support at, it looks like 2850-ish, and it goes all the way down to 2700. So 22% drawdown. So if you go ahead and you think about your positioning, whether it's from fiat to Ethereum or just sitting in Ethereum, being able to move into fiat right now to get better positioning in ETH, I personally hate doing those sorts of things because you're never timing it the way that you want to time it. In terms of moving from fiat to spot, like if you're in ETH, like you might as well just kind of sit there and figure out how to go ahead and stack more. So 20, 21, 22% drawdown would be almost like kind of worst case scenario in my head. Mm-hmm. Are you going to go ahead and earn more with some of these opportunities that I'm mentioning? Because that's what you're foregoing right now, is the opportunity to get better positioning on some of your position, like 22% discount. Are you going to get greater returns over the next month or two based upon some of these opportunities? I actually think yes, you will. So with that rationale and that kind of thinking there, it's like, why would I even bother trying to figure out if it's going to go down? Why am I going to spend all that time? If anything, let me explore some of these new opportunities. Let me go through the docs to try to understand, like, okay, where do I need to move my token to be able to get into some of these positions to gain the exposure that I'm looking for? You know, to me, that's a better use of time right now.
I think it's an excellent perspective for those who are already allocated in some of these assets. Maybe they're on the fence of whether or not they should be getting in or out of them. You're diving deeper into the ecosystem, trying to make more of it, and which is a different mindset, I would argue, than those who are looking to your set. I like the language, trying to get a better position.
Yeah, let me just add one thing, Marconi, since we're talking about liquid restaking tokens, and it was a good trend earlier this year. It was a significant narrative in Ethereum, and a lot of people got excited and it gave a lot of debates, pros and cons over what was happening in terms of the security of the protocol. But if you go back to DeFi Summer 2020, and you had Uniswap show up and everybody was starting to LP, and then you had Compound go out and actually kind of make its mark on how to bootstrap capital and reward that capital with its own native token comp. And it just sparked a lot of interest. And it took some time before the market really just roared and came to life, because it wasn't until the end of 2020. And we had liquid restaking tokens show up earlier this year, and there was significant interest around it. And it was reminiscent of kind of when Uniswap brought a new model to the market. Now, what Symbiotic is doing is they're actually going to enable ERC20s to go ahead and use this model, which in some ways creates some utility for some of these DeFi projects that have lacked utility to this date. It's going to be like its first mark to be able to move. It's kind of, if you think of it as a spectrum of its token having some utility, like its first step past the governance utility model, which I think we can be frank here and say the governance utility model right now has no utility. So the fact that we're going to see kind of like a 0 to 1 moment for some of these projects, like, you should be alert to this and you should be aware of it, that it's coming, because they're going to, once it starts to show up and you see projects starting to go ahead and embrace this type of model, it's going to really move fast. So understand this part of the market. This will be DeFi Summer. Maybe summer's not the right word, but it's going to be kind of a reignition of some of these DeFi projects, because some of them, like Aave, I think I saw a stat, it was like 6 months of profitability now. Like, that's unheard of right now. And it had a rough start, but it's just trending up and to the right now. And you're seeing other projects get a little bit of product market fit at the moment. Granted, there's not a lot of users. So what happens when users show up and you have that profitability start to rise? And then I think Aave who decided that they want to go ahead and launch their own protocol and move outside of Ethereum. I mean, this is right here. This is projects. This is yield farming again. This is the pickle jar showing up probably, and somebody's going to make a project that's called something weird and funny. But eventually you're going to have that trend meet the meme coin trend. And to me, that's going to mark, like, we're probably 95% into this rally. We're very close to the peak, but that's when things are going to get absolutely bonkers. And it's going to be fun to watch, but I do believe this is the trend that's probably going to create a lot of attention, garner a lot of interest, and you're going to see a lot of people build on top of it.
So are you looking at a time perspective? I mean, we talked about, the next couple of weeks, we talked about September as sort of these lines in the sand for the Fed or for the Dixie. Does any of that factor into what you're talking about? Is it really path dependent? You're looking just for more volume to continue to build up. You're looking for more account usage, more fundamental activity to really start to in your mind, solidify this. Maybe it's long weekend DeFi versus DeFi summer, DeFi long weekend, DeFi month.
Well, after the Bitcoin ETF was rolling, a lot of these stats just looked better. Right? Upward price movements tend to do a lot of things to fundamentals. Like right now, Ethereum, its gas fees are atrocious. I think yesterday it was like 9 or 10 Gwei, and it's been the lowest it's been in 4 years. That's a bit of a warning sign. Okay, so from a fundamental perspective, Ethereum doesn't look that great. Like, it's having some growing pains as people are moving to L2s, applications, instead of moving to L1 because they know what's going to happen in a bull environment in terms of fees, and users won't be able to use the protocol as much. So they have to go ahead and build on an L2, and they're making those decisions every day now. And I know Solana's winning some mind share as well. That right there, like, this is growing pains. So Ethereum, in order to kind of like get past a bit of that kind of these terrible fundamentals that it has in terms of the demand for block space and compute on Ethereum, like, it needs a bit of a positive flywheel effect from an ETF. Like, it does do numbers to a lot of the stats, like some of our token rating models, which, you know, eventually we recorded an interview where I went ahead and discussed some of the ratings that we built internally, but they don't look that great at the moment on the demand side for Ethereum. But I guarantee after the ETF, you'll see some of these things start to pick back up. And that will just kind of create this momentum that the market needs moving into the end of the year. And then, of course, you got some rate cuts and you got probably a lot of dovishness unfold. And then we're just off to the races for Q1 2025. And you'll see meme coin season get reignited at some point, probably in late Q1, Q2, and, you know, things will just get nutty.
Getting nutty. I like that. All right. Well, there you have it, folks. We've got some lines in the sand over the next couple of weeks, which should get everyone a little bit excited, especially as they're taking a little bit of summer breaks. Maybe it's time to be a little bit close to that terminal in case those opportunities exist. You can be looking more at what JJ's talking about, which is starting to layer in positions, kind of being prepared for that risk off if it happens, or just being able to continue to accumulate as the market starts to trend towards a weaker dollar, if that's the case. And then alternatively, you can be looking at what Ben's doing, which is trying to really get more deeper into the ecosystem and make more of that. I think either one could be an interesting play for you. With that, we are going to wrap it up today's show. I want to thank everyone for joining us here on X. We are simulcasting both to X and to YouTube, but if you want to comment, if you want to get questions, if you want to interact with the team, you're going to have to do it here on X. This is where we're responding. But JJ, Ben, Lily, thank you so much. I will say Thursday, we will not be here. We're going to be away from the show, but we are looking to release some content, so keep an eye out on that, and definitely follow our socials. We'll be telling you what's going on. With that, keep some dry powder. You never know what's around the corner. This is Marconi White signing off.